Well, hello, everyone. Thank you so much for joining me tonight. Should be a fantastic presentation. Uh, if you do have any questions during the presentation, feel free to, you'll see on the bottom of your screen, the little icon that says raise your hand. Feel free to ask me any questions during the presentation, or if you want, I'll also be staying on at the end for any questions you may have in the finality. So again, thank you so much for joining us tonight. We do have a lot of good information, pretty timely information. This is mainly a kind of a recap of 2022, as well as my thoughts are what should be playing out here in 2023. Obviously, a very trying year. Really didn't make a difference if you were more conservative, aggressive, stocks, bonds, international, domestic. This was painful. Inflation was a horrendous reality for everyone. There is no benefactor when it comes to inflation being a problem. But we need to kind of digest what happened, why it happened, and what that means going forward, what kind of makes the most sense. So if you just give me 1 second, let me share my screen. All right. So let's start with the stock market and we'll kind of take it from there. So what we're looking at, just give me 1 second. What we're looking at right here is more or less US stocks for the last 25 years. So just to kind of give us a little recap, a little history of how we got here. The 90s were fantastic for stocks. They really couldn't miss, one of the biggest and best bull markets of all of our lifetimes. And that was mostly focused on growth stocks and technologies, similar to what's kind of going through right now. And what's happened was the tech bubble burst. The reality of companies were kind of getting way out of hand. They weren't really profitable. And then the good times just came to an end. So more or less, stocks got cut in half, bottomed out, found a floor, and then continued to rally. Markets peaked around 2008. And then we got what it was hit with the financial crisis. That financial crisis where 2000 and the tech bubble was mostly focused on technology and growth names. 2008, which much more of a value problem. Problem was in real estate, in the banking sector, your typical kind of value core. From 2009 up until COVID, that was the longest rally or period of time where stocks did not have a 20% correction in our history. Then obviously COVID happened. Fastest decline ever, 6 weeks, 34%, incredibly painful period of time. And then the government took out a bazooka and said, we're going to print almost $10 trillion and make this problem go away. Doesn't make a difference if you were a city, a state, an individual, a corporation, everyone got money. So everyone invested realized if we win, we get to keep it. And if we lose, they're just going to write a bigger check. Hence why the stock market rallied at the fastest pace in the history of this country and got all the way to all-time highs, which we hit on January 3rd of last year. So the problem in 2021, well, not the problem yet, but it was starting to be a problem, was inflation. Now, inflation was in the 5-6% range, but the government was fairly confident that it was temporary. It was due to some bottlenecks that were going to be worked out. The reality of there was a bunch of stimulus money that people were spending, but once kind of that fuel got burnt up, that things should calm down. And then in the first half of 2022, we had kind of a double, triple whammy. You had the Ukraine-Russia issue, which sent energy prices and food prices through the roof. You have the Omicron surge here, and then you had China continuing to lock down pretty much up until couple months ago. Major cities where major factory was. So any hope that inflation was temporary was completely blown to bits. So we peaked in January of last year. Now you have to remember the stock market is always thinking 6 to 12 months ahead. So we knew inflation was a problem. That means the government was going to step in and raise rates. Raising rates is painful for everyone. It hurts the bond market, it hurts the stock market, it hurts corporation. Think of it that the higher rates go, the more things cost. If you got a 30-year mortgage at 3%, I'm going to make up some numbers right now. Let's say it cost you $1,500 a month, but now a 30-year mortgage might cost you $2,200. So that's $600-700 that you no longer get to enjoy and spend on, vacations and restaurants and other expenses, because now goes towards debt. So the higher the rates go, more eats into the economy. So the economy was actually pretty good this year. Companies' profits were at all-time highs. This was actually the second best year on record for the employment in terms of people going back to work. Let me repeat that. 80 years, this is the second best year for jobs numbers. We probably averaged 400,000 new jobs every single month. So stock market's looking ahead. So it thinks 2023 is bad. So even though 2022 was good, the stock market went down. I'm going to break through what I think is going to play out in 2023 and what that means for the stock market. So recapping what the stock market did in 2022, like I said, we peaked in January as inflation became bigger and bigger problem, and we don't know where the floor is, meaning how high rates have to go to kill inflation. That really is the main thing when it comes to markets. And what markets hate more than anything is uncertainty. When you know the government's going to raise rates and we don't know what it's going to take to cool inflation, people freak out. Volatility goes crazy. So this is why first half of the year was rather tremendous. Bonds getting killed, stocks getting killed. You're paying $5 for gas, food's going crazy. For the average consumer and their sentiment, close to the worst on record. So stocks dropped 20% by May. At which point, after the Fed has raised rates a few times, the Fed came out and they said, we think we're getting there. We think we're pretty close. We'll see how things go. We'll play it by ear. Markets love that. Went from down 20 to only down about 10, and then realized they spoke way too soon. And they said, whoa, inflation's still a problem. We have a long ways to go. Markets went back down. So everyone got their third quarter statement. Markets were down about 25%, which as of right now has been the bottom of the market. Then we started getting some numbers in October and November that inflation is meaningfully coming down. We saw the Feds do a slight pivot. So they've been raising at 0.75 a month. They saw inflation come down. Now we've lowered it to 0.5 a month. The Fed, we're supposed to get an inflation number tomorrow, and then the Fed's going to meet in the next couple of weeks. We believe it'll be a 0.5% rate increase, which is already baked into the cake. So, just because the Fed actually comes out and raises it doesn't mean we're going to feel any more pain, because the bond market and the stock market are already acting as if it's already done and will be followed through on by the Fed. Small chance of also it only being a 0.25% move. So again, the smaller the move, the more the bond market and the stock market's going to love it, which is great in the long run if inflation continues its path down. The outlier situation is the Fed takes their foot off the gas too soon, inflation creeps back up, and instead of this 1 year of pain, it drags on. So they are very conscientious of this. This is also what caused the 70s, the entire decade of the 70s, to be very painful. So they really, I believe, will be rather hawkish in terms of making sure they take care of this reality. So as we sit here at the end of the year, markets finished the year roughly around down about 20. So really from May until the end of the year, markets just kind of gyrated and kind of went nowhere. In my personal opinion, this market is going to look like a U. So as we look at COVID, it was a sharp decline and a sharp recovery. It looks like a very sharp V. This is going to be taking a little bit more time. So hence why I think we have our downturn, which call it down 20, 25, 30, somewhere in that reality. I think it's going to bounce around here for a little while before we start the next bull market. I'm going to go in the next few slides. I'm going to go into a little bit more depth, but for now, I just want to stay on the stock market. So kind of just some basics I always like to go over. So let me take one step back. So whenever we're analyzing stocks, we're always curious how cheap or expensive they are. So what we're doing is taking the price of the market and you divide it by what the companies are earning. Now you could do it over last year's earning, the future earnings over kind of an average over the last 10 years. What we're looking at right now is your typical multiple is just looking at 1 year forward earnings. Now 10 is you're buying stocks very cheap. If we only have to pay 10 times earnings where we were at the bottom of the financial crisis, your normal next 10 years in the market are going to be great because you're buying at such a cheap point. At the top, 21 times earnings, 25 times earnings, these are two of the most expensive in history. Now, this year's or that 21 that you see there is almost somewhat reasonable because there's also a relationship between stocks and bonds. So if you were sitting here at the beginning of this year, you're saying, all right, well, stocks are kind of expensive, I'm going to get out. Well, what's my alternative? The alternative was the bond market, which was paying 2% and inflation was 6%. So people were scratching their heads, I'm going to get out of this to go sit in something paying 2 and I'm going to lose 4% to inflation. Hence why the stock market got pretty much a little bit more expensive than it normally would because there really wasn't an alternative. So we're always conscientious of the multiple. So right now we're paying about 16 and change. Now, when we look back at history, we can say, all right, what's reasonable? Well, 16 has actually been about average over the last, I would probably say 20, 30 years. 40, 50 years has probably drifted down a little bit, kind of average would probably be between 15 and 16. So what does that mean? So far over last year, stocks went from expensive to fair value. They're not terribly cheap and they're not expensive anymore either. They're reasonably priced. So when we look back at history and we say, all right, well, if the multiple is where it should be, what has kind of been rates of returns, that's where the reality you're typically getting a high single digits for stocks. So 2008 financial crisis, you bought stocks at 10 times earnings. Well, the next 10 years in the market, you average 15% rate of return. Now our multiple, we're paying 15, 16 times earnings. That's normally correlated to high single digits, like I said. Now, this is a great slide to kind of compare. All right, we know what our multiple is, 16. Well, what happens? What's the probability over 1 year? What's the probability over 5 years? And so anytime someone says with great degree of certainty, well, this is the rate of return of the stock market over the next year, it's really fairly unpredictable to predict. So if we have a multiple of 16, and these are all the different realities that have played out over the course of the years, well, we see some years where having a 16 a multiple, we got as high as like a 35% rate of return. And we've also seen down 20% rate of return. So any 1 year, that spread is fairly unpredictable. Now, as you go over, instead of just looking at 1 year, but longer periods of time where we're looking at 5 year, that standard deviation is narrower. It becomes much more of a predictable reality. So if I were to give you a rough estimate, hence why I'm saying you probably get a high single digit reality over the next 5 years. Now, to kind of back into that would be this slide here. So like I mentioned, the peak was January of last year. Now, what this slide here on the left is going over is, all right, if we just get back to even and we did it in 1 year, well, the stock market needs to earn 26% in that 1 year just to get back to the highs of January. I truly believe, like I said, this will look a little bit closer to a U, not so much a V. So let's say it takes 4 years. It means you're going to average about 7.5% in US stocks. That kind of makes sense based on where the multiple is as of right now. Now, there's 3 worlds that all of my clients are invested in when it comes to the stock market side of the equation: US stocks, international, and emerging. International and emerging are much cheaper than us. So they're starting at a much lower valuation. Emerging markets are trading at about 11 times earnings. Europe and Japan are probably trading at about 13 times earnings. So they're much cheaper. So that means they have much more upside potential, which I'll go over in a little bit. But if I were to give you a bet in Maine over the next 5 years, US stocks about 7, international developed 8 to 9, emerging markets probably 9 to 11, much more of an opportunity. kind of what's also helping international and emerging is the companies and the exchange rate. The US dollar shot up to all-time highs. So when our dollar is at all-time highs, it's very hard for our companies here to sell goods to Europe. It's much easier for us to buy European goods because we're getting them at a discount because our value is worth more. But Europeans don't want to buy our stuff because it costs so much because the US dollar is appreciated. So it's a double whammy helping international and emerging going forward. The dollar should come down in value, as well as their multiples should be going up in comparison to ours. So I think you're getting a little bit of premium being international going forward. Now, with regards to the actual economy, so what we're looking at right here is projected earnings for the S&P 500 companies. Now, 2023, most economists seeing a slight pullback. It's probably pretty close to 50-50. You know, in terms of scenarios that can play out, we have a fantastic year, beautiful growth. We have an atrocious year, kind of your tail risk. You know, maybe that's 10-15% realities, but your base case, the heart of your bell curve, is probably pretty close to 50-50 of shallow recession, which is looking like it'll look around the second or third quarter, or getting by and we kind of get through this. This is a really unique period of time. It's really odd to be possibly heading into a recession, and last month the economy added 250,000 jobs. It doesn't make a lot of sense. So as of right now, if a recession does come, most companies are forecasting a rather shallow recession. Now, inside of our investments, we're, like I said, invested in stocks. Now, there's typically two types of stocks, value stocks and growth stocks. Now, this has hurt growth much more than value. So last year, growth stocks were down 30-35%. Value stocks, your banking, your real estate, and your more dividend-focused stocks only went down about 5%. That's because growth stocks are expensive. As of right now, I still have a tilt towards value stocks. I still think it absolutely makes sense in this current reality. I think you're still going to get some multiple compression on the growth side, and value probably outperforms for a cycle. So, for example, after the downturn of 2000, it really was up until 2008, 7-8 year period where value stocks kind of did well. So for now, I certainly have a value tilt in the portfolio. This is a great slide. So what you're looking at right here, the red dots is kind of your worst pullback during a course of a year. And the gray is where the stock market really finished, or actually finished at the end of the year. So as you can tell, there is pain almost every year. And this is really going hand in hand with the psychology of an investor. Everyone always hates the stock, always feels like they're down, always feels like they're taking it on the chin, because the market's constantly giving you a pullback. It's very rare that you're always sitting at your all-time highs. So we just have to understand that the stock market's always going to give us something to be scared about, always something to be worried about. Stocks go up over time. It's really that simple. You know, to go back to the earnings sheet that I went over before, this is companies' earnings going back to the 80s. Companies consistently make more money. We have more people here. We have more need of spending money. Companies are constantly innovating, finding ways of increasing revenue and cutting expenses. It's kind of worked for all of time. Markets are always going to follow earnings. Earnings typically consistently go up. Now, that doesn't mean they go up perfectly like a CD. There's always going to be pullbacks, but as you could tell by 2023 and 24 and 2025's projections, they're assuming 10-15% increases in earnings over that time period. So companies tighten their belt, which they're doing right now. That's where you have some layoffs, cutting expenses, making sure your balance sheet's okay, really protecting net income. a lot of times this is healthy. A lot of companies kind of get some extra going, especially in the growth part of the market these days. They were pretty much growing at any cost. So focusing on the bottom line is sometimes a little bit of a healthy reality. Now, why we're not predicting too much of a deep recession is what we're looking at right here is what I would call kind of like the four horsemen of a recession. So we have housing on the top left, vehicle sales, companies' investments in their businesses, and kind of inventories. Now, a good example of this is the 2008 financial crisis. As you can tell, housing got crazy expensive, formed a bubble, and a bubble had burst. Now, all of these are going back, looks like 40, 50 years. What you could tell is they're pretty much at or below their long-term average. So it's kind of hard to crater really big when you're not really high to begin with. You know, it's like saying if you're in a building, it's kind of hard to get hurt if you jump out the window and you're only on the first floor. So nothing is really signaling between these four here, as well as the unemployment number and the jobs growth number. You know, you still have 10, 11 million job postings for only 5 million people looking to work. We have a really healthy economy. You know, you hate to go through these pains and inflation, but it was a really good time to do it because we were pretty healthy. So that doesn't mean we're immensely going to turn and go on a bull market tomorrow, but the pain we will feel, I don't believe it's going to be too deep, at least when it comes to the actual economy. Another thing is housing inventory. This is more just a general question that does come up, and what I think about prices. Always something to consider. Every small area, you know, northern New Jersey, Florida, Phoenix, South Dakota, everyone has their own unique reality playing out. But in terms of the entire country having a housing problem where a bubble is going to burst and housing prices are going to crash, it's kind of hard. A lot of it's based on supply and demand. You know, this is housing inventory. We're still really close to almost all-time lows in inventory. Well, if there's not a lot of houses up for sale, there's not a lot of supply, it's kind of hard for prices to crater. So, you know, in terms of three realities, you know, robust economy, crater, crash, bubble bursting, or muddle through, a lot of this is signaling kind of a muddle through type of reality. You know, the next year or so might not be great, but it's probably kind of a break even type reality. Hence why, you know, kind of economists are on the 50-50 line of recession or not recession. Now, something I touched upon earlier was the sentiment of consumers. You know, this is consumer confidence or kind of consumer sentiment, which goes back to the last 50 years. Like I said, it pretty much touched people's feeling about the economy, pretty much hit all-time lows, which is kind of incredible. You know, you don't normally have a feeling of all-time lows when companies' profits are at all-time highs and the unemployment number is close to all-time lows. But as you saw the bond market crater, as you saw it become harder and harder to buy a house, as you saw interest rates and mortgages go up and you saw your stocks go down and the cost of goods going crazy because of inflation, I get why people felt like this was horrible. So, but, you know, in reality, comparing this to 2008, this wasn't anywhere near as bad as the 2008. And pretty much people felt as if it was worse than 2008. Now, the big takeaway from this slide, as you see all these bottoms that played out, and it looks like we've bottomed, you know, you could double dip, but as of right now, your average bounce from the bottom is almost 25%. So statistically, this is saying over the next year from now, markets should go up 25%. My personal base case, like I said, is a little bit more of a U. This is going to take a little bit longer where we're kind of bouncing around the bottom before an upswing comes. But the concept is markets have always brought you an upswing. 100% in the history of America, if you stay diversified and get just exposure to markets, all downturns are followed by a recovery. I do think this will be a little bit more drawn out, but the recovery will come sooner or later. I have a slide on unemployment, but kind of conceptually went over it. like I said, you still have 1.7 jobs for every person looking for a job. Nothing like that is played out in history. So even if you're getting layoffs and all this is going on, and there's 5 million extra jobs for not even a person looking for it, let's say they all went away, that really doesn't change the employment number, because those were just extra jobs that people weren't filling anyway. So again, we have a pretty healthy reality right now in terms of the job market. Now, what all of this boils down to is inflation. So inflation's looking like it peaked in kind of the May, June timeframe of last year, and it's pretty much consistently gone down, which is fantastic. That's goal number one, have it to come down. We're actually getting a reading tomorrow with regards to inflation. Hope if this is in the 60s, sixes or mid sixes, I think the stock and bond market have a decent little day. But we absolutely want to go down. And really the second thing after we've accomplished that it's going down is the pace. So we have a battle going on. It's coming down, but inflation, the Federal Reserve is raising interest rates to get it come down fast. They want to get it to 2-3%. So hopefully it's coming down a good enough pace, and hopefully the Fed will only, in my opinion, probably raise it 0.5% this go around, and then drop off to 1/4 after that and have a wait and see approach. We're going to go into the bond market and where the Fed fund rate is going to go in a little bit, but the story around inflation is, it's as of right now, it's looking like it's peak, and it's absolutely going in the right direction. Which ties into the Fed's funds rate. So this was the most painful Fed increases in history. We more or less went straight up. Now the Fed has already signaled that they're looking to trying to get to 5, possibly 5.25, and have a wait and see approach. Because what they also realize, as they raise rates so fast, it takes a little while for it to work into the economy. So they're inflicting pain, but they know the pain might be not felt for 3 to 6 months. So they might say, well, we just did a whole bunch of medicine. Let's see how it plays out, which beautiful. We'll take that reality all day long. So if we're already around 4.5, and we're probably going to 5, that means we're pretty much about 90% of the way there in terms of feeling pain. So in very simplistic form, when we're talking about the bonds in the portfolio, we feel pain as interest rates go up. As they plateau and go sideways, that's no problem. That means we're not feeling any more pain in terms of the bond's value going up or down. We just collect the interest. Well, I'll sit here and collect 5% interest rate from our corporate bonds all day long. So upside pain kind of limited at this point. If it goes sideways for a while, beautiful, we'll collect 5% rate of return. If what we see here in the dotted lines play out, that means a lot of the pain you felt in bonds, we're going to get rewarded that we stayed in them. Because as interest rates go down, the value of bonds go up. Think of it, if you have bonds paying 5% and bonds go back to where they're only paying 2 or 3%, your bonds are worth more money. So the green line here is what the market predicts. The blue line here is what the Federal Reserve predicts, both kind of signaling the same thing. So main piece to take away from this slide is most of the bond pain's behind you. I don't mind plateauing. Beautiful. We'll stay at a nice high rate. Everyone on this call is either at or in retirement. We want to stay in a world where our bonds are paying us 5%. It makes our lives a whole lot easier to generate a good rate of return to have your money last you forever. It's been very painful as bonds pay so low. We have to have more in stocks to generate a decent rate of return. It means a bumpier ride. So yes, it was painful for bonds to get up here, but we got something for it. We're collecting higher rates on our conservative investments. CDs rates going up, fixed annuity rates going up, bonds paying at a higher rate. That's a good thing in the long run, but it was kind of like ripping off a really bad Band-Aid. Without a doubt, worst pain we've felt in the bond market on record by a whole lot. But that pain's behind you. What's this page? So to kind of summarize that, we just kind of went over that slide. So this is bonds over the last 50 years. So the gray is the calendar year rates of returns. You'll see a down 3, a down 1, down 2, down 2, and a down 13. That kind of tells you how much of a seismic shift that we've experienced in the bond market. You went from 0 to 4.5% in about 10 months. It's an incredible move, hence why the amount of pain. But typically going forward, what we saw was quick snapbacks. So the plateau period was relatively short the last 3 times this happened. In which case, okay, we didn't stay up here, but we recouped a lot of those pain. So when the bond market lost 3%, we rallied back 19. When down 1%, we rallied back 12. I'll take either one of the realities. I don't mind staying up here. I don't mind delaying the snapback or spreading out the snapback if we get to keep these higher interest payments going forward. So bond market, bond pain, we've gotten the best point to own bonds in 15 years. Yes, we took pain to get there, but all we could do is look at where we are today and what makes the most sense going forward. You know, I thought this is a pretty good slide. And, you know, for the people that, hey, I don't really understand the stock and the bond market and I just don't really look at it, you know, I want to give you an example in where, so in this example, let's say you play roulette and you have that little cheat sheet that they put up and they tell you what landed, you know, red or black, and you say, oh, red hasn't hit in a while or black hasn't hit. That's meaningless. That's literally them tricking you. Statistics don't work that way. Every one spin is unique to that one spin. You know, showing you what the last 10 things happen has no impact on this next thing. The stock and bond market don't operate the same way. When you get bond pain, it's for a reason, and you're getting something for it. For that bond pain, you went from a 2% coupon payment or interest payment. Now you're getting a 5% coupon payment. We haven't seen that since 2007. So yes, you felt pain. You know, let's say you lost 5 times in a row playing roulette. You're saying, oh, I'm doing the 6th. No, you're not. You have the same exact statistics, same exact probability. When you felt a lot of pain in the bond market, it was like a rubber band being pulled back and you snap forward. You got something for it. Now, it's different if you own individual stocks or individual positions. Sometimes when you feel pain, those things might not come back. You know, if you were a Sears investor and Amazon's taking over, that pain you're feeling in Sears is not going to snap back. It's going to go bankrupt. So individual positions, you might have winners and losers. But markets, stock markets, where your multiple is going down, you're going to have a snapback. It's pulling a rubber band because you're buying things cheaper and cheaper. The bond market, as interest rates are going up, you're feeling pain, but you're getting something out of it. You're getting higher rates. You know, that's the main thing. You know, you always want to ask yourself, as I look at a statement, you know, everyone's year-end statements were painful. I get it. But did I get something? Was I in a bad product? Or was this just a bad market? Well, markets go down, but markets come back up. Bad products, you know, if the stock market was up 20% this year and we're down 20, that means we have something's wrong. There's a bad product. That shouldn't happen. So again, always ask yourself, am I just in a bad market or is this just a bad product? But stocks and bonds, you win over time. You know, gambling is just odds, then they're stacked against you. So again, just realize this pain you felt this year typically means your future years you're going to be getting a higher rate of return going forward. This kind of slide ducktails into that. So this is kind of how much interest you've been receiving on all different types of bonds: government bonds, municipality bonds, corporate bonds, mortgage-backed bonds. This has been what the average payments you have received over the last 10 years. Well, this is how much you're getting paid now. So for the pain, you're now going to collect double the interest going forward. Is more or less the concept I want everyone to get. I touched upon this earlier. You know, something people need to realize, you know, the benefit of diversification is things do good or bad at different times. So why do we have international and emerging markets? Well, it's been hard to realize why for the last 10 years, US has done great and everything else has done poorly. But things tend to go through cycles. Now, we just have gotten to the point where our multiple, how many times earnings we're paying for stocks, is a big spread versus international emerging. US stocks are at 16, international emerging are kind of the 11, 12% range. There's normally a spread, just not nearly that big. You have the US dollar close to all-time highs. That's kind of stacking the deck, US versus international. So like I said, this is probably a good time. If you don't have any international and emerging market exposure, increase it a little bit, right? Or, especially emerging markets, in my opinion, will probably have a very nice 10 years. Similar to the period of 2000 to 2010. What happened in 2000? We had a tech bubble burst where growth stocks got hurt. What just happened? We had a bubble burst where growth stocks get hurt. You had a 10-year period from 2000 to 2010 where the US dollar went down in value. US stocks made no money for that decade. Emerging markets averaged 8% a year. So things go through cycles. This has been a great 10 or so years for US stocks. 2000, 2000 says you want to be more international. 90s were great for US, 80s were great for international. Things go through cycles. And as always, we just have to understand that staying invested simply wins over time. If I can't predict the downturns, but I know if I just leave it alone, I typically get a great rate of return in the long run. Over any 1 year period of time, flip a coin whether stocks or bonds going to be up or down. So the deviation is rather large, but over time, things get more and more consistent, more and more predictable. And if I were to focus on one, if we're focusing on the gray over every 5 years, there's never been a 5-year period in the last 72 years where anyone has lost any money if you just stayed calm and ride it out the storm and just left your investments alone. We've had crazy, scary times. Vietnam, 9/11, we had COVID. We shut off the entire world. And as long as you stay calm and relaxed, you were fine. So always want to stay disciplined. And mentally, you kind of want to always create 2 buckets of money. The money you might need in the next year or two, you shouldn't have much. 2 years is a long time. This is why I always push emergency funds. 6 months of your fixed expenses, plus any one-time purchases. I don't want risk. Leave it alone. I don't care if it earns nothing. Cash liquidity. But over that, we want to earn money. We need our money to be working for us. We have to beat inflation. If inflation is going to be 3%, well, besides emergency money, every other dollar we own, if it's not making 3%, is losing value. A great slide that's kind of new to this booklet of slides. I've never quite seen this broken down so much. So the gray bars are 6-month CDs and how much interest they're paying. Blue is headline inflation, kind of a basket of costs. So how much are they going up? Education, medical expenses, and housing. Once you realize cash is meaningless, all it does is buy stuff. Buys houses, buys health insurance, buys education, and of course your everyday goods. Now, you could have got away with CDs and cash in the 80s and 90s and 2000s. Let's look at the 90s. Medical expenses were a wash, and your overall inflation and your housing expenses were down here. So your CD money held its value. For the last 15 years, if we look at the 2010s, your 6-month CD was paying you 0.5% interest. And these are the different inflations that are eating away at the purchasing power of your dollar. The only thing in the long run that you shouldn't hold is dollars. Yes, if you need it in the next year or so, safety is first. But if you have that covered and we're not earmarking any purchases, that money is slowly getting corroded by inflation. And especially inflation's higher, it's getting brutal. It's just getting corroded faster. So once you realize all cash does is buy stuff, and if the stuff goes up in cost and my dollar didn't, I'm losing. So especially your 10, 20, 30-year money you're going to leave as inheritance, cash is not the best place. But I thought that was a great slide. So to recap my thoughts for 2023 and why I think it's going to be a U, I must have slipped over the slide. Give me 1 second. So this is the last 9 recessions. Now, the gray is the actual recession. That's period where the economy is shrinking. As of right now, most economists are saying the recession or a slowdown will be in the second and the third quarter of next year. The green line is when the stock market bottoms. 8 of the last 9 times, the stock market bottomed right in the heart of the recession. So if we think the recession is second and third quarter, that means the stock market should probably bottom in the May, June, July timeframe. So hence why it looks like a U. It got to, as of last May, it went down to 20. I think it's bouncing around down 20. And anywhere here to me is about reasonable. I wouldn't be surprised down 25, down 30. Definitely plausible realities can play out. But I would look for the second half of this year to get some sort of foundation, because at that point we should have a much better deal of what the Fed has done and plans of doing, much better idea of where inflation is going to be. And hopefully a wrapping up of the Ukraine-Russia reality, the more certainty that gets played out, more planning can be done, more certainty, typically more stocks go up. The more uncertainty is off the table, the more people are willing to pay for stocks. So this year, your guess is as good as mine, but it's more about timing of things. In my opinion, it looks like a U. I don't know if that recession continues to get pushed off because the employment number stays great. But it's not, the recession is not here today. It's not going to be here in the next week or two. But we will have some sort of slowdown, even if it doesn't cause a recession, probably towards the middle of this year. But just remember, in the long run, downturns normally go down about 35% year and change. Bull periods after that normally go up about 350%, normally last you about 5-6 years. The key is to just hold on through all downturns. Well, that ends my prepared discussion points. If anyone has any questions, feel free to raise your hand. And of course, if you don't want to ask in front of the group, this is actually the biggest group we've ever had. Yeah, I'm not surprised after a year like this. Call me, email me. I'm happy to go over any of these slides in a little bit more detail. And just feel to reach out at any time. All right, not looking like any questions. So again, thank you so much for joining me. Love and appreciate you guys. Any questions, feel free to reach out. Thank you so much.